Picture this scenario. You're sitting in your office at 3 p.m. on a Wednesday watching the clock tick by while your boss drones on about quarterly projections, and suddenly it hits you. The crushing realization that you've got another 15 years of this before you can even think about retirement. Another 15 years of meetings that could have been emails. Another 15 years of pretending to care about corporate initiatives that change every 6 months. Another 15 years of your life slipping away while you build someone else's dream. Sound familiar? Well, what if I told you there's a specific dollar amount and a precise strategy that could shave 5 full years off that timeline? What if those 15 years could become 10 and you could be sipping coffee on your back porch at 55 instead of 60, watching the sunrise instead of rushing to beat traffic? Most people think early retirement is reserved for tech billionaires or lottery winners. They picture someone who either got incredibly lucky with cryptocurrency or inherited a fortune from a rich uncle they never knew existed. But here's something that might surprise you. The real secret to retiring 5 years sooner isn't about making millions or finding some magical investment that doubles overnight. It's about understanding a mathematical reality that most people completely miss. My name is Alex, and I spend way too much time thinking about money, investment strategies, and why some people seem to crack the code of financial independence, while others stay trapped in jobs they hate for decades longer than necessary. I retired from investment banking in my mid-30s not because I struck it rich on some crazy deal, but because I figured out the mathematical relationship between savings rate, time, and compound growth that most financial advisors never bother explaining to their clients. If you're someone who wants to understand the real mechanics behind early retirement instead of just hoping things will work out eventually, make sure to hit that subscribe button and give this video a thumbs up if it helps you see your financial future differently. Now, before we dive into how $500,000 can transform your retirement timeline, let me ask you something that will probably make you uncomfortable. When you think about retirement planning, what number comes to mind? Maybe you've heard that you need $1 million to retire comfortably. Perhaps some financial advisor told you that 8 times your annual salary is the magic formula. Or maybe you're like most people and you have no idea what number you're even aiming for, so you just contribute to your 401k and hope it all works out somehow. Here's the thing that's going to blow your mind about retirement planning. The difference between retiring at 60 and retiring at 55 isn't just about having more money saved up. It's about understanding how compound interest accelerates exponentially in those final years before retirement. Most people think wealth building is linear, like filling up a bathtub one bucket at a time. But the reality is that wealth building follows an exponential curve, and the steepest part of that curve happens right before you hit financial independence. Think about it this way. If you've ever watched a snowball roll down a hill, you know that it starts small and grows slowly at first. You're pushing and pushing, making very little progress and wondering if this thing is ever going to build momentum. But once it reaches a certain size, something magical happens. The snowball starts growing faster than you ever thought possible, picking up more snow with each revolution until it becomes this massive force rolling down the mountain almost effortlessly. $500,000 is that turning point where your financial snowball finally reaches critical mass. Everything before this point feels like you're pushing uphill against gravity. Everything after this point feels like gravity is working in your favor, accelerating your progress toward complete financial freedom. But here's where it gets really interesting, and this is something that will probably surprise you. The difference between having $500,000 and having zero isn't just mathematical. It's not simply that you have more money generating returns or that your compound interest is larger in absolute terms. The real magic happens in how this amount changes your entire approach to risk, opportunity, and decision-making. When you don't have significant savings, your brain operates in what psychologists call survival mode. Every financial decision gets filtered through fear and scarcity. You take the first job offer that comes along, even if it's terrible, because you can't afford to be selective. You stay in positions you hate because leaving feels too risky. You say yes to overtime you don't want because you need every dollar you can get. This isn't just about being practical or responsible. When you're in financial survival mode, your brain literally cannot think about growth and opportunity. It's like trying to plan a vacation while your house is on fire. Your mental bandwidth gets completely consumed by immediate threats and short-term survival, leaving no room for strategic thinking about your future. But something remarkable happens when you cross that $500,000 threshold. Suddenly, your brain has the space to think differently about risk and reward. Instead of asking, how do I survive until the next paycheck, you start asking, how can I optimize my path to complete financial independence? Instead of being reactive to whatever financial crisis pops up, you become proactive about accelerating your timeline to retirement. Research shows that having substantial savings creates what economists call option value. When you have money in the bank, you have options. And having options creates opportunities to make even more money. This is what wealthy people mean when they say money goes to money. It's not some cosmic conspiracy where the universe rewards people who already have cash. It's that having money gives you choices, and choices create more opportunities to build wealth. Here's something else that happens around the $500,000 mark that most people never talk about. You start thinking in terms of systems instead of just goals. When you're broke, you set goals like save $1,000 or pay off credit card debt. These are important milestones, but they're essentially defensive financial moves designed to stop you from going backwards. When you have $500,000 working for you, your thinking shifts from defense to offense. You start asking questions like, how can I optimize my tax strategy to keep more of what I earn? Should I consider real estate investments to diversify my portfolio? Would it make sense to start a side business that could generate additional income streams? These aren't just random thoughts anymore. They're strategic considerations backed by actual capital that can make these opportunities realistic. The psychological shift is enormous because it affects every aspect of how you approach your career and your money. Before you have significant savings, you're essentially trapped in whatever situation you currently find yourself in. Your boss could be terrible, your job could be mind-numbing, your commute could be soul-crushing, but you can't leave because you need that steady paycheck to cover your basic expenses. This puts you in an incredibly weak negotiating position for everything from salary discussions to career advancement opportunities. You can't ask for the raise you deserve because you're afraid they might let you go. You can't push back on unreasonable demands because you need the job more than they need you. You can't explore other opportunities because taking time off for interviews feels too risky. But $500,000 changes the entire dynamic. Suddenly you have what I call walking away money. Not enough to retire immediately, but enough to survive for years while you find something better if your current situation becomes unbearable. This doesn't mean you should be reckless or burn bridges unnecessarily, but it means you're negotiating from a position of strength instead of desperation. This psychological shift affects everything about how you show up in your professional life. You start asking for the promotions you deserve because the worst they can say is no, and you'll be fine either way. You push back on projects that don't align with your career goals because you're not afraid of the consequences. You explore new opportunities because you can afford to take some calculated risks. risks. Here's what's really crazy about this transformation. Often you don't even need to use your walking away money. Just having it changes your entire demeanor at work and in life. You become more confident, more assertive, more willing to speak up in meetings and challenge ideas that don't make sense. And guess what happens when you start showing up differently? People notice. Suddenly you're getting better assignments, more recognition, and yes, higher compensation. It's like having a secret superpower that you hope you never have to use. But knowing it's there changes everything about how you operate in the world. And the beautiful irony is that the more confident and successful you become in your career, the faster you accumulate wealth, which gives you even more options and confidence. But let's get into the actual mathematics of how $500,000 can cut 5 years off your retirement timeline. Because this is where things get really interesting and frankly a little mind-blowing when you see the numbers laid out properly. The traditional retirement advice tells you to save 10 to 12 times your annual salary by age 65. So if you're making $75,000 per year, conventional wisdom says you need somewhere between $750,000 and $900,000 to retire comfortably. The problem with this approach is that it assumes you're going to work until you're 65, collect Social Security, and live modestly on about 70% of your pre-retirement income. But what if you don't want to wait until 65? What if you want to retire at 60 or even 55 while you're still young enough to actually enjoy those retirement years? This is where the math gets really interesting because early retirement follows completely different rules than traditional retirement planning. When you're planning to retire early, you can't count on Social Security because you won't be eligible for benefits until much later. You also can't rely on traditional pension plans that most people don't have access to anyway. Early retirement is essentially about building enough wealth that your investments can cover 100% of your living expenses without any outside help. The magic number that most early retirement experts talk about is 25 times your annual expenses. So if you spend $60,000 per year, you'd need $1.5 million to retire using what's called the 4% rule. The theory is that you can safely withdraw 4% of your investment portfolio each year without running out of money over a 30-year retirement period. But here's where most people get this calculation completely wrong. They assume that building wealth happens at a steady pace, like putting $500 into savings every month for 30 years until you eventually hit your target number. The reality is that compound interest creates an exponential growth curve that accelerates dramatically in the later years. Let me show you exactly what I mean with some real numbers that will probably shock you. Let's say you're 35 years old, you're saving $2,000 per month, and you're earning an average return of 8% on your investments. At this pace, it would take you approximately 17 years to accumulate your first $500,000. You'd be 52 years old when you hit this milestone. Now here's where it gets interesting. Your second $500,000 doesn't take another 17 years. It only takes about 8 additional years because now you have that first $500,000 working alongside your monthly contributions, generating its own returns and accelerating your progress. By age 60, you'd have accumulated roughly $1 million. But what if you could front-load that first $500,000 by just a few years? What if instead of reaching $500,000 at age 52, you could hit that milestone at age 47 through a combination of higher savings rates, strategic career moves, or additional income streams? This is where the math becomes absolutely incredible. If you reach $500,000 at age 47 instead of 52, that same 8% annual return working over those extra 5 years means you'd have approximately $1.47 million by age 55. That's enough to retire comfortably using the 4% rule if your annual expenses are around $58,000 or less. Think about what this means. By accelerating your path to that first $500,000 by just 5 years, you've essentially bought yourself the ability to retire 5 years sooner. The compound interest on that extra time creates enough additional wealth to support an entire decade of early retirement. But here's the part that really blew my mind when I first calculated these numbers. The difference between retiring at 60 and retiring at 55 isn't about saving 5 more years' worth of money. It's about giving your existing money 5 additional years to compound and grow. Those 5 extra years of compound growth on a $500,000 base create roughly the same amount of wealth as 10 additional years of saving $2,000 per month without any existing capital. This is why hitting that $500,000 milestone becomes such a psychological and financial turning point. Once you reach this level, time becomes your ally instead of your enemy. Every additional year that your money compounds is worth multiple years of your previous savings efforts. Now you might be thinking this sounds great in theory, but how do you actually accelerate your path to that first $500,000? Because clearly this isn't about just saving harder or cutting more expenses. If it were that simple, everyone would be retiring early. The real secret lies in understanding that there are only 3 ways to reach financial independence faster. You can earn more money, you can spend less money, or you can make your money work harder through better investment strategies. Most people focus exclusively on the spending less part because it feels like the most controllable variable. But the math shows us that earning more money has a disproportionate impact on your timeline to financial independence. Here's why increasing your income is so powerful. When you cut your expenses by $500 per month, you free up $6,000 per year for savings and investments. That's meaningful progress, but it's limited by how much you can realistically reduce your spending without making your life miserable. But when you increase your income by $500 per month through a promotion, career change, or side business, you don't just get $6,000 more per year for investing. You get that extra income for potentially decades, and each year compounds on top of the previous year's growth. A $6,000 annual income increase sustained over 20 years and invested at 8% returns creates over $275,000 in additional wealth. This is why I always tell people that career optimization should be your primary focus in your 30s and 40s, not just expense cutting. The decisions you make about your career trajectory during these decades will have a bigger impact on your retirement timeline than almost any other financial strategy you can implement. But here's something most people don't realize about career optimization that could completely transform your approach to building wealth. The biggest jumps in income rarely come from annual raises or cost of living adjustments. They come from strategic job changes, skill development that positions you for promotions, or creating additional income streams that leverage your existing expertise. Let me tell you about Sarah, someone I've been mentoring for the past 3 years. When she first came to me, she was 38 years old, making $65,000 as a marketing coordinator, and convinced she'd never be able to retire before 65. She had about $45,000 saved across all her accounts and was contributing just enough to her 401k to get the company match. Sarah's problem wasn't that she was a spendthrift or financially irresponsible. Her problem was that she had accepted her current income as fixed and was trying to optimize her way to early retirement through budgeting alone. She was clipping coupons and eating ramen while her biggest asset, her earning potential, sat completely underutilized. The first thing we did was audit her skills and identify what she could leverage to increase her income. Sarah had been doing marketing coordination for 8 years, but she had never bothered to learn the strategic side of marketing or develop skills that would position her for management roles. She was essentially doing the same job she had been doing 5 years earlier, just for different companies. Over the next 18 months, Sarah invested about $3,000 in online courses and certifications in digital marketing strategy, data analysis, and project management. She started taking on more strategic projects at work, volunteered to lead cross-functional initiatives, and began positioning herself as someone who could think beyond just executing marketing tasks. The result? Within 2 years, she had leveraged her new skills into a marketing manager position at a different company, making $92,000 per year. That's a $27,000 annual increase, which translates to over $2,200 more per month in gross income. After taxes, she was taking home roughly $1,600 more each month than she had been before. But here's where the story gets really interesting. Sarah didn't use that extra income to upgrade her lifestyle. She maintained the same modest living expenses she had before and invested that entire $1,600 monthly increase. Combined with her existing savings rate, she was now putting away over $2,800 per month toward her early retirement goal. At that pace, Sarah will hit her $500,000 milestone in her mid-40s instead of her mid-50s. And once she reaches that point, the compound growth on that foundation will likely allow her to retire in her early 50s with well over $1 million in investment assets. That career optimization move didn't just increase her income. It accelerated her retirement timeline by more than a decade. Now you might be thinking that Sarah got lucky or that her situation was somehow unique. But I've seen this pattern repeat itself dozens of times with people I've worked with. The individuals who reach financial independence fastest aren't necessarily the ones who save the most aggressively or invest the most cleverly. They're the ones who figure out how to systematically increase their earning potential throughout their careers. This is where most traditional financial advice gets it completely backwards. Personal finance gurus love to focus on cutting out lattes and canceling subscriptions because these tactics feel actionable and immediate. But the math is pretty clear. Cutting $5 per day in coffee expenses saves you $1,825 per year. Increasing your income by $20,000 through strategic career moves gives you over 10 times that amount to work with annually. And here's the kicker. Income optimization and expense optimization aren't mutually exclusive strategies. You can and should do both. But if you're going to focus your energy somewhere, focus it on the side of the equation that has unlimited upside potential rather than the side that has natural limits. The beautiful thing about income increases is that they create a compounding effect beyond just the extra money you can save and invest. Higher income often comes with better benefits, including more generous 401k matching, health savings account opportunities, and access to financial products and services that weren't available at lower income levels. Higher income also gives you more flexibility to take advantage of tax optimization strategies that can significantly improve your after-tax returns. When you're making $45,000 per year, maxing out your 401k contribution might not be financially feasible. When you're making $95,000 per year, you can potentially max out both your 401k and a Roth IRA, dramatically accelerating your tax-advantaged wealth building. But let's talk about the investment side of the equation, because this is where a lot of people with good savings rates still manage to sabotage their path to early retirement. Having $500,000 means nothing if that money is sitting in savings accounts earning 0.1% interest or invested in actively managed mutual funds that are charging you 1.5% in annual fees, while underperforming the market. One of the most shocking things I discovered when I started mentoring people is how many intelligent, successful individuals have absolutely no idea what they're actually invested in or what they're paying in fees. They'll spend hours researching the best deal on a new laptop, but they'll put their entire financial future into whatever investment options their HR department recommended without asking a single question about costs or performance. Here's a reality that might make you uncomfortable. The difference between earning 6% and earning 8% on your investments doesn't sound like much, but over the timeline we're discussing, that 2% difference can literally add or subtract years from your retirement date. On a $500,000 portfolio, the difference between 6% and 8% annual returns is $10,000 per year in additional growth. But it gets worse when you factor in fees. If you're paying 1.5% annually in management fees and expense ratios on funds that are underperforming the market anyway, you could be looking at effective returns in the 4% to 5% range instead of the 7% to 8% that broad market index funds have historically delivered. This is why I always tell people that investment education isn't optional if you're serious about early retirement. You don't need to become a day trader or start picking individual stocks, but you absolutely need to understand the basics of asset allocation, diversification, and fee structures. The few hours you spend learning these concepts could literally save you decades of additional working years. The good news is that optimal investing for early retirement is actually much simpler than most people think. You don't need complex strategies or exotic investments. You need low-cost, broadly diversified index funds that track the overall market performance, and you need the discipline to keep investing consistently regardless of what's happening in the news or the economy. But here's where most people struggle with the investment side of building wealth. They get emotionally hijacked by market volatility and make decisions based on fear rather than mathematics. They'll invest aggressively when the market is going up and get conservative right when they should be buying more shares at lower prices. This emotional decision-making can completely derail your path to that $500,000 milestone. I've seen people who were on track to hit their goals get spooked by a market correction and move everything to cash, missing out on years of compound growth while they waited for the perfect time to get back in. The reality is that market corrections and even bear markets are features of the system, not bugs. They're opportunities to accumulate more shares of quality investments at discounted prices. When you have a 15 to 20-year timeline to retirement, short-term market volatility becomes completely irrelevant to your long-term success. This is another reason why having a substantial emergency fund becomes so important for early retirement planning. When you know you have 6 to 12 months of expenses covered in readily accessible savings, you never have to sell investments at a bad time to cover unexpected costs. You can ride out market downturns and even take advantage of them by continuing to invest when prices are low. Now let's address something that's probably been nagging at the back of your mind throughout this entire discussion. What about healthcare? This is the question that stops more people from pursuing early retirement than almost any other concern. And honestly, it's a legitimate worry that deserves serious consideration in your planning process. Look, retiring 5 years sooner isn't about some get-rich-quick scheme or finding the perfect investment that doubles overnight. It's about understanding that $500,000 represents a mathematical tipping point where compound interest finally starts working harder than you do. The psychology changes, the opportunities multiply, and suddenly that distant retirement dream becomes an achievable timeline you can actually see on the horizon. Start building that foundation today because your future self is counting on the decisions you make right now.